So I'm going to ask a challenging question now.
Sure. Go for it.
What stops a broker from establishing the relationship that the liquidity providers have with the banks? If a broker's got a lot of volume from all their retail traders,
They could do that, yeah. They could do that. But what is important to understand now here is that a liquidity provider, you cannot compete with the retail brokers. You cannot be on the same market. Like you are targeting, let's say, Europe, and there is a brand very well established in Europe, and then suddenly you are their liquidity provider. You can see the flow, you can manage the flow as a liquidity provider, and at the same time you go and you compete with them. Now the second thing, for them to come into this stage, it means that they have to start building up lots of different systems that the liquidity providers started building themselves to help their business, their main source of business.
here we are, another podcast session with Pantelis Michael, CEO of Broctagon Prime and also shareholder. I actually need to adjust my introductions here. I've been advised. So I need to also tell the audience, please like, subscribe, and share this content to increase the audience, right? So I think I'll prepare my introductions a bit better for that because, somehow I need to get this channel a bit more. And I think with your help, Pandeli, thank you for your time. Let's hear about your background. Sure. Introduce yourself. I think you're the right person to say where you're from. Let's go. Let's help the audience, the retail trader, understand what a liquidity provider does in the industry.
Perfect. So my name is Pantelis Michael. As you mentioned correctly, I am the director of Proctagon Prime and a small shareholder. I've been in Proctagon Prime from the beginning, and I believe that we are doing a good job when it comes to the liquidity. Now, about the liquidity part, shall we give an explanation how it works? Mm-hmm. Shall we start from now?
I think let's build up to there, and I think let's start a little bit with your background. Where were you before Broctagon Prime? And just to so when Broctagon Prime was founded, you were from the beginning?
Yes, very correct. Very correct. So let's take it a few steps back. Okay, so
go with
2006, came to Cyprus, started working with Easy Markets. Back then, I believe there were only 2 or 3 brokers in Cyprus. We left in 2008. We went to another Forex broker, which is Tada FX. After that, X Global. After X Global, to FX Globe. And from FX Globe, Broctagon.
And in these roles that you were, so from 2006 you started where Easy Markets. Easy Markets is one of the
oldest.
Well, now they're one of the oldest for sure, but 10 years ago they were one of the most popular. Their name came up a lot more often. At least from my perspective, their name came up a lot more often 10 years ago than they do today.
It's a very different sort of market that they're targeting from their side, I would say, but it's at the same time it's a very good, for us as employees working in Easy Markets, was a very good school. It's a very good university. We learn a lot of things about the market, and that's why if you go back to all the executives from other Forex companies, you will see that at some point they started from Easy Markets.
Right. I met with the CEO of Easy Markets in an unofficial, let's call it like a little bit of an interview for, he had already made his hire. He was looking for Chief Information Officer or Chief Technology Officer, I can't remember. And I met him.
Technology.
And I met him at the Starbucks, and he just wanted to see, what I'm about, whatever it is. It never materialized, but I met him, and that was interesting. Okay. And you said you moved. Where were you before? Didn't you grow up in Cyprus? You said you came to Cyprus.
I came back to Cyprus from my studies. I studied in Leeds, Leeds Uni. And when I came back to Cyprus, the first job that I got was in Easy Markets. Back then it was Easy Forex.
Right. Yes, correct. It was Easy Forex back then, and then they changed. So what was your role there? Dealing?
I started as an account manager. Then I moved as a senior account manager for the USA markets, because back then USA was allowed to get under the USA, but at the same time Easy Markets had the NFA license.
NFA?
NFA,
Which
Natural Futures Association.
Oh, okay.
They were registered with the
US.
CFTC, yes.
Okay.
I believe that was not the best decision for them, because the market in the United States was more advanced at that time. We were a very good retail broker, but back then we were offering conditions on the Eurodollar like 10 pips fixed spreads.
Jeez.
So we had to compete with companies like FXCM, Interactive Brokers, that they were like 2 pips. It was very difficult for us to sell anything in the States.
And the reason that Easy Markets was not able to go lower than 10 pips on the Eurodollar is because they had many intermediaries up until
they go into the conditions that they're going to get something like a 3 or 2. At the same time, the cost behind it was too big, so they couldn't lower that cost to that level.
So why was the cost of Easy Markets then more than, say, for example, Interactive Brokers, or how is Interactive, the likes of Interactive Brokers or FXCM, which are huge, right? They're massive. How are they able to do that, to give a spread of 2-3 points versus Easy Markets, which is not small?
It's not. Yeah. So the way that we have to see that and analyze it is the clients that they were targeting in the first place. So FXCM and Interactive Brokers, they started from the US markets. So people there were more advanced of using the internet back then. You had credit card deposits that they were more easy for those brokers to accept comparing to our days. Easy Market started here in Cyprus, but it was targeting European clients and Middle East clients. The use of credit card back then wasn't that popular as it is right now. So based on the audience, Easy Markets was targeting clients that they were not experienced enough, and therefore the conditions, they had to be a little bit higher on spreads, and so they can attract more through the marketing that they were doing, because most of the expenses of Easy Markets was going back to the marketing.
Right. Okay. And the Natural Futures Association, when I hear that, I never just heard of it now and didn't know that. NFA. So the NFA, if I take that acronym and try and understand that what they regulate is futures on commodities like wheat, corn, these kinds of contracts.
Let's take it a step back. Actually, the regulators in all the countries, they weren't specifically created for the Forex companies. They were created about the exchanges, like the future exchanges, as you mentioned correctly. So like wheat, like oil. So the market developed to an extent that the retail brokers or the CFDs brokers, they had to be regulated. So the governments did not go and set up another CFTC or another NFA. They just decided, okay, let's put them all together under the same regulator. So that's why you will see that in the NFA you have very limited number of brokers that they're operating in the United States.
Because it's just the business model of the retail broker is different to, let's call it, these institutions that require hedging or whatever it is that they deal with, these natural contracts, let's call it, these commodities, where the retail is just for the speculation of the smaller trader. And, the smaller trader wants to participate with CFD products.
CFD's products, yes.
That are fed in with quotes from the, let's call it the regulated entities that have this the NFA,
The NFA license.
which makes sense. So I now understand why you said, for easy Forex back then, it didn't really make sense for that maybe it was an overkill for them to get such a...
It was just following the trend at that specific time. The United States was a very popular market, very easy to access credit card deposits. So on marketing perspective, it was going to be easier for easy markets as well to boost their brand in a country that is easier to be used. So they thought that it was a good decision back then to move to the States.
When was it that the US banned CFDs?
Completely banned the CFDs, that's not a correct word to use, but because it was a gradual banning, let's say. So they put restrictions, first of all. The first restriction was that you have to be an eligible counterparty in order for you to operate in the CFDs market. The second thing that happened, and it happened to us because we were based in Cyprus, was that even though that we were not NFA regulated or CFTC registered in the United States, but we were regulated in another jurisdiction, we kept on accepting US clients. That was between 2006 to 2010. So during that time, we kept on getting USA clients because it was easier to approach those clients. NFA started contacting directly all those brokers without even going through the communication channel like the rest of the regulators. They just came straight, knock on our doors and said, you have USA clients, you're not allowed to do so, and you have until this day to close all the accounts and return all the funds back to the clients. And I remember specifically in one of the companies that I worked, we had this contact with NFA and we said to them, okay, we're going to follow that request, but the existing positions of the clients on a floating basis, they were losing money. So is it okay if we have it until, I think it was, we asked for an extension for 2 days so we can inform the clients so they can close the positions in probably with a smaller loss so they can withdraw their funds. In the beginning, they said yes, but the following day, they came back to us and they said, you know what? No, I set that specific date, close everything. And we contacted all the USA clients, and all the USA clients, they were familiar with that.
Okay.
They were expecting it. And they said, okay, we understand.
Okay.
We're going to close our accounts. We're going to withdraw our funds.
Because they knew what was happening.
Yes.
And yeah, I mean, you're correct to say it wasn't a ban, because it's not banned, but there's a very high requirement from the regulator. You can offer CFD products, but you need 20 million,
yes,
whatever it is in dollars, that you're not allowed to touch. That's just to maintain the license. So they added these restrictions, and it is almost like you've kind of blocked the majority of the smaller, the small to medium-sized brokers.
You don't want them anymore. Yeah.
Yeah. As a business, it maybe is not sustainable. So, and on the NFA was, brokers like Easy Forex or whichever brokers were operating in the US, were they onboarding clients to trade in Forex and metals and all of these CFD products?
CFDs products, yes.
CFD products, all based off of this NFA as a kind of gray area?
Yes, but that was when it was under the NFA. I left from Easy Markets in 2008, but based on what happened back then was that, yes, by the end of 2008, they already left the United States market.
It was getting too tough to do business there.
So they even withdraw their license.
Mm-hmm. Understood. And you were account manager there?
Yes, senior account manager that is handling clients.
So you were on the phone speaking to each customer or whoever you were responsible for?
Potential clients, leads that they were giving us from the marketing.
And kind of just helping them, explain how the markets work, just kind of direct support, this is how you open a trade, close a trade, et cetera.
Show the platform, the system, how it works. how you make a deposit. And this is how we got introduced into this market.
Yes. It's, and as you said, these companies that existed, whoever was in these companies, it was like a little university, a school. Like a school that at the end of the day, practical experience trumps any theory you learn from the university. So you moved from there to Tada, which is also quite big. Or I don't know if they still exist.
It was big.
It was big
back then. So with Tada, we started from scratch, new company in Cyprus, regulated by SISEC. So we started again going after the same markets that Easy Markets was managing, was targeted by 2008. And we expanded quite a lot in Europe. We had a good presence in Europe altogether. The approach that we had that was different comparing to what we had in Easy Markets was that we had a more personal contact with the clients. Now, in Easy Forex, because it was only a numbers game, we never met clients. We never knew the clients' faces. We were running the KYC reports, we were running the KYC requirements and everything, but we never met the clients. Now, in Tada, though, we were flying over to meet with the big clients. We had clients that we knew about their families, what they were doing, what is their main source of income, how did they invest, what is their trading strategy. And slowly we understood that we were shifting from that clients or the numbers attention to more on a personal level connection with not all of our clients, because this is impossible, of course, but to the bigger names, you had to have a good relationship with them. So we were flying pretty often.
Oh, you'd even meet with them in person?
Face to face several times.
Okay. And European customers, obviously?
Yes, of course.
And so there again, it means that you were still, again, a senior account manager in...
Started as a dealer in TWFX. And I moved as operating division manager because I was managing clients, sales, and I had the contact between the sales and the dealing team back then. Back then, it was still a manual hedging on the dealing side. Because I went to the dealing department and I saw how was the dealing was working, but I had the background coming from the sales, I found out that they had a conflict between them. So I was the person that I tried to connect the two departments. Always, these two departments, they always come in conflict in any company. The one department works on increasing the profits of the company, the other one just brings the money in.
Exactly. There's conflicts everywhere within the departments. Yes. Compliance wants to apply a full strict regulation, while the sales say just
you have to bring the money in. Yes.
So, what's the perfect balance? I remember there was a broker that I was working with, and they were in their startup phase, and I had introduced them to a tight agent out of I can't remember which country, and they were still startup, and this business for them meant like it was good business, and their compliance said no, without having like proper, and it wasn't anything shady, but just because the tight agent was in Albania or whatever it was with in Greece, I can't remember the exact details. It was just a little bit too with this, let's say there was a 0.01% chance that this might not be good, she blocked it right out. So
that's the only clue she needs, the compliance department, just to stop any deal.
Who knows who's right or wrong, but what that did mean was no business. She did her job exceptionally well.
The truth is, compliance is probably one of the most difficult departments in the industry. They are employed by a company that they want to make money, they want to run profits, they want to have a sustainable business, but it's always conflicting with their requirements. So whenever there is that chance, as you mentioned, the 0.01% chance to block the deal, they will try to block the deal.
And it's hard to find that meeting point where two pulling from both ends, because I can also understand the compliance side, right? You can't be a salesperson and go and make empty promises and say you're guaranteed to make money, deposit, and push.
This is not acceptable.
Personally, it's not acceptable. And also, from a personal standpoint, I agree with that. Don't say that. It's wrong. Good. And then you moved. So your build-up up until Broctagon was mainly switching between dealing and account management.
Account management, operations, mainly on the operations department, because as you start with the sales, and to be frank, Easy Markets was way advanced when it comes to the systems that they have from their side. So when I moved to Tada FX, and we saw a company without any systems, it was like impossible for us to imagine that.
How will they operate? Yeah.
How do they operate without any systems? So slowly you start to build your own systems, because back then, again, 2008, 2009, there weren't so many companies to help out on the systems, on the CRM side, on the marketing, on the back office, online access for client portal for the clients. Bridges, fixed API bridges, they were not available. I remember we had a meeting with Prime XM, and it was directly with the owner of Prime XM. And he sat and he was trying to introduce us to the Prime XM bridge. And we were looking at him and we're like, no, this cannot work. It's not possible. It's not there. And we kept asking. And he eventually convinced us that you have to try. And we're speaking about one of the big bridge providers
today. Yeah.
Yes, main name.
That is where people see opportunity where the majority don't, right?
That's very correct.
Yeah. That is where businesses, I guess, that start out and see that opportunity where you might not even know that yourself that it is actually there, and you need it and you don't see it for yourself. Those are the people or the businesses, I guess, that capture a big market and also do very well. And it's in any industry, not just in ours.
Yes.
Right?
I agree.
So we never knew we needed mobiles before the mobile came.
That's very correct. Yeah.
Right? We were with pages and whatever it was.
Now it's mandatory for any Forex company that when you're going to get a platform, you need to get a bridge at the same time.
Yes.
So in reality, it's like back 2008 to 2010, you would say that you needed to have an MT4 platform so you can promote your brand to a company. Now it's the MetaCodes platform, or probably another platform, and the bridge and all the other things that you can introduce to make the clients to come to your company.
Right.
It's a mandatory.
And so all of that experience, Panteliss, for you, I guess, helped you and set you up for which, I think many would, and I certainly do consider a great success today, where you were one of the founders of Broctagon, right in the beginning, Broctagon Prime, which didn't have not one single lot of trading volume. And today you're at whatever it was. These are milestones that for me, whenever we do a catch up, the last that I remember was you were at 80 yards. And I'm like, that's impressive. And then today, just before our podcast, you told me you're at 250. Well, actually, before that, I was at 150. Now it's 250. I'm like, that's pretty impressive. Let's talk about what are the moving parts. How does the engine of a liquidity provider work? What is it that you need to do to provide your service to brokers in the industry? And also, we've on this podcast, we've spoken quite a few times about what a liquidity provider is or whatever it is. But I think it would be really good to hear your description. What is a liquidity provider? In a short description, explain it to it like a 5-year-old. Like what if you had to tell a 5-year-old, what a liquidity provider is? And then let's go a little bit more, expand on that and discuss the different points of the parts that, of a liquidity provider.
If I try to explain it like a 5-year-old, it's going to be a little bit difficult. I try to do it with my son.
Yeah.
He's 6, but he doesn't get it.
Yeah.
But I will try to make it as simple as possible. So, same with the history of the Forex companies. Easy Markets had a pricing system that was coming into their platform with their own technology, and they were streaming those prices out to the clients. In Tada, when I moved to Tada, I saw that the prices are coming from the banks. You're getting the prices from the banks. You add a markup on the prices, and you introduce those prices to the clients. So the system was basically the client was trading with Tadawul, and Tadawul was hedging everything back to back with the bank. So if the client was buying euro-dollar at 110, you have to get a better price from the bank, 109. This is as simple as it can go. So this was an ongoing task for the dealers back then. That was very time consuming, first of all, because we were covering back to back the trades. We didn't know that there is a risk management way of looking to the things, which is better not to explain at this stage. But this is how we were doing it, and we were calculating the profits of the company altogether. Now, at the end, close to the end of, before I leave Tada, that's when the bridge and the bridge providers came in place. So they said, wait a minute, guys, what are you doing? So you're using an MT5 system, you're getting the prices from the bank, and you add a small markup on the prices, you're sending it to the clients, and the clients are trading on those prices. You're pretty much creating like a small market. So you buy one item at $1 and you try to sell it at 110. So your profit is at 10 cents in this example. So the bridge provider helped us, and all the bridges, they helped us out to go after several banks at that time. So the banks, they saw an opportunity from their side, like if I compete with the prices of another bank, I can get more flow from them. Getting more flow, I can hedge that flow into the real market and make more profits out of the prices. So the fixed APIs that is provided by the bridges helped us out to open up with several banks. So the several banks that they were opening, they were giving better spreads to win the flow from the broker. And brokers ended up becoming more. They were multiplying the brokers because they saw an opportunity into the market, and they started giving better conditions towards their clients. So moving forward, bridges started doing a main business in the industry. They were helping both brokers and the banks. So this is when the liquidity providers came along, and they said, this is a broker, it's a good broker, makes good volumes. They know how to do a risk management, because as I gave the example before with the 1 and the 110, now it's different. They calculate it per currency. They don't hedge back to back. They hedge on specific levels. They hedge based on their capital adequacy, that even the regulators now, they have a very good idea how it works. The whole system, they know that. So those brokers, they said, I don't need massive sales. I don't need massive marketing. I don't need to have overheads of close to $500,000 to start a Forex company. I just want to concentrate assisting those brokers. At the same time, when those liquidity providers were coming out, you saw banks that they were leaving out of the equation, because they said you had brokers that they were decent, very good brokers, but you had also brokers that they were not sending any flow, and they were trying to make just some easy money for a couple of years, and then they were just going to close their business and they're going to move to another brand. That was very common on those days. So those LPs, they found this opportunity and they said, okay, you don't need to go through the banks. Now the banks, they became very difficult to open up an account with. I will be the one that I will be connected with all the banks, and you just come to me to get the flow. And this is how the liquidity providers started doing the business on their side.
Okay. Let's touch on a few points here. So the first question I think that will naturally come up in that description is, and in the very easy to understand initial example you gave is, a customer gets a price, for example, of euro dollar with a broker 110. That broker, to make money, gets that price from the bank 109. And
This
that's
is on the example
0.01 is their profit, that's their revenue.
This is only when you are STPing everything back to back.
100%. Which STP is still happening today.
Yes.
In a different way, not exactly back-to-back hedging, which what that means, just to explain to the audience, is one single client sent a trade, that exact trade with the exact size volume, that exact price request is sent to the market, and then it comes back one by one, hedged one by one. Where now it works a little bit differently. There's aggregation, as you mentioned, many different clients opening different positions that might have crosses with common currencies. So euro dollar, GBP dollar, whatever it is. And then a correct risk management system takes a consolidated or accumulated, let's call it a summary of all the traded instruments in all the currencies and cover their exposure based on each single currency and not back to back on every single one trade, which is not efficient. But now my question goes back to that very simple example, which I think helps. And that's a trader sends 1.10 in the Euro USD example, and then the broker gets it at a better price. What stops the trader from going directly to the bank to get that 109?
This is where the broker started closing that door, but at the same time, because the banks, they were having high requirements to set up accounts with them. They were minimum deposits, monthly fees, different platforms that most of the clients, they were not familiar with. It wasn't an MT4 or an MT5. None of the actual banks uses an MT4 or an MT5.
Yes.
It's whole different systems. You even have, and you still have that, you have some banks that they never gonna settle the P&L, because you will select that you're gonna have, okay, let's not make it that complicated, but let's assume that you're trading euro dollar and your account is in dollars, then you will get everything settled in dollar. But if you're trading euro GBP and you close that exposure on the euro GBP, then you still have an exposure on GBP that is running until you decide that you want to withdraw the money. And this is the actual Forex. This is not something that the clients really need to care. They want to speculate. They want to trade something simple, and that's why MT4 and MT5 is such a huge success.
Right. And so what that basically means, and described in a kind of a different way, which is easy to understand, is the reason why a trader is not able to, or they could, to go and get that price of 1.09 is because in this example, instead of getting it for 110 from the broker, they get it for 109 from the bank, is because that broker has got so many more other expenses or requirements that the bank has, which the single trader with their one small little trade, it doesn't make sense for them. But for the broker, it makes sense because they've got a large audience
and a portfolio
of traders. And for them, there's, let's call it economies of scale, right? You meet the requirements of a bank, and then on top of that, you factor in your expense. That's why that 0.01 exists, so that the broker can cover that expense in bulk. So they get bulk trades.
And they can introduce it to the retail market altogether.
Makes sense. Okay. Moving on, you touched on other points in the example that you gave. The liquidity providers, how they came about, how they came to be, and the reason they exist. And you mentioned the margin accounts, right? And how the market has shifted. Could we tap into that a little bit more?
Sure.
Yeah.
There are two reasons now that those liquidity providers, speaking in general, is that they found this opportunity to assist the Forex brokers without having to run the same business and compete with those retail brokers in the market. Because as the years were going by, marketing was becoming extremely expensive, and you already had some very big brokers that they were well established in different markets. A newcomer has to has to compete, first of all, with existing budget that an established broker is using in order to start getting some results. At the end of the day, even if you are a newcomer, and as a newcomer you start introducing these conditions to the clients, it's going to take a few years until you get yourself established. We were running some reports that we needed at least 2 to 3 years just to
break even,
to come and break even as a newcomer. So this is where the opportunity started in the first place. So liquidity provider said, okay, I'm not going to go in that side of the equation with the retail clients. I'm going to be here. So something in the middle between the banks and the brokers. Now, the whole thing there now is what are the conditions that you're going to offer to the broker? Because at the end of the day, the broker is the one that is facing
the retail trader,
the retail client. Yes.
So I'm going to ask a challenging question now.
Sure. Go for it.
What stops a broker from establishing the relationship that the liquidity providers have with the banks? If a broker's got a lot of volume from all their retail traders,
they could do that, yeah. They could do that. But what is important to understand now here is that as a liquidity provider, you cannot compete with the retail brokers. You cannot be on the same market. Like you are targeting, let's say, Europe, and there is a brand very well established in Europe, and then suddenly you are their liquidity provider. You can see the flow. You can manage the flow as a liquidity provider, and at the same time you go and you compete with them. That's the first thing. Now, the second thing, for them to come into this stage, it means that they have to start building up lots of different systems that the liquidity providers started building themselves to help their business, their main source of business. Because here you have the back office, the CRM, you have a website, you have client portal, you have credit card deposits, EMIs, several bank accounts, different licenses in different jurisdictions, and so on and so on. But here you're more concentrated. You have lots of bridges, you have lots of connections to different liquidity providers, different risk management tools to the ones that the retail broker does and uses. And all this together is basically like you're setting up a different entity. We saw brokers that they tried to move from B2C to B2B and they failed. And we saw brokers that they were trying to move from B2B to B2C and they failed.
That makes so much sense for me, and I can elaborate on that and give other examples, right? So, so the B2C means business to consumer, so the client, the retail trader, and B2B is business to business, obviously, which is what a liquidity provider is. And I agree 100%. Those are two, even though they're within the same industry, two separate businesses. The retail trader has so many other systems to maintain and understand and configure that a liquidity provider needs, which a liquidity provider has all these other systems and a higher, in many cases, a bigger expense, because to set up the bridges, a lot of them have minimums. It's not cheap.
Yes.
The bridge can get expensive because also there's a volume-based charge. The more volume you have, the bigger the expense. Yes, you're making more money, whatever it is, the bigger the volume, but there is a very big base expense. And two different entities. And then if we break it down even more, and this is more kind of, in the scope of DGM, we would be able to assist the Broctagons of the world, but the majority of the entities we service is the retail. And we've seen this as well, and I can expand on that. A retail broker, it's if they decide, for example, that they're going to do the CRM in-house, or they're going to build the bridge in-house, or they're going to do whatever technologies that exist by third parties in-house, they're essentially onboarding or loading onto their expenses other entities, others offering. So because there are CRM providers that's all they do. That's the only thing they
specialize in that product.
Exactly.
They know that product.
100%. So they specialize on that. They do it for many multiple brokers. So at scale, their development increases exponentially to the need to accommodate the needs of many multiple different brokers and their different business models. While if you're one single broker, you're going to onboard all of these developers and go through all that process of coding and bug fixing and whatever it is. And then there's opportunity cost. You could go live right now, whereas if you decide to do it all in-house, you're going to go live much later. And that's just one example.
Yes.
Right? And that even also, I'm going to speak a bit about DGM now. That gap of the service that's needed, the skill set that's needed to maintain all these systems is also something that is a business in itself. That's what DGM does. That's what we own. That's what we do. We focus only on the platforms that a broker needs and maintain it and configure it. The broker can, very rightfully, as you said, they can do the liquidity. They can do the set up the relationship with the banks and set up all the systems for liquidity provider. In the same way, the broker can also hire their personnel, but then people leave, people come. It's a whole, the human resources side of things with intellectual property, people coming and going, because it's a competitive market even for human resources. It's hard to find. There's a gap there. So that for me makes a whole lot of sense, and if you take any entity, there are certain things that the broker should focus on and some things that might make sense to outsource. And then again, it depends on how small or big the broker is. Like if you're a massive broker with like 500, 600, 700, 800 employees, developers and whatever it is, then you're big enough and you've got that, those resources in-house to do whatever you want. And I guess, in the long term, you do save because you custom build, whatever it is. But we're talking about very few rare brokers.
Yeah, in reality, an example, let's say a very big broker, which we know very well, everyone knows them. They were using a specific bridge provider, which it's their specialty. They know how to create the fixed APIs. They could actually bought the bridge by themselves because they are massive. But what they did, they kept on working with them until they developed their own system to close it down. And that is just one example. There is not more than 2 or probably 3 in the market nowadays. Even if you are the biggest broker, you cannot have everything in the same.
You can't do everything because at the end of the day, you do spread yourself thin.
You have to.
And every single little project that we're talking about, so in one entity, if you decide, the management decides, we're going to do this ourselves, we're going to do this by ourselves, everything in-house, whatever, every single one of those decisions is actually a little business in itself, which comes with, expenses and the requirements, to adhere to and to become successful. And then that also impacts your main business, your main flagship service.
You don't focus on the actual business because even if you are, as you said, we have the marketing for the retail and the sales at the same time. So marketing, that's something that you have to keep on focusing month in, month out. Same with the sales. You have the expos. In our case, that is more on a B2B level. But again, you have to be there.
Yes.
You have to show that. So shifting that focus as an entity, and when a company becomes bigger and bigger, we notice that worldwide, that entity cannot move, is not as flexible as the smaller companies are.
Right. Yeah, and that's also definitely the advantage that a small business has is its agility to maneuver. If you're a big company, and you've got many employees and you've got your processes and your policies in place, it's very difficult for you to change.
You just don't move. You never move.
Like it's comparing this big container ship
Yes.
that needs to change direction versus a speedboat. You just swing it to the
change it. That is true. And because we are onboarding those brokers, like you have those groups that are coming as clients, and it's taking us 3 months to get all the documents organized, go through the connections and everything, and you're looking and you are amazed. You're looking and you say, how are these guys operating? Why is it taking them that time to set it up? When it's a new broker, you're speaking directly with the directors. In a week time, you have everything connected. They're ready to go live. They understand everything. But this is because it's a startup or a smaller one. The groups are like this. In all the industries, I believe, it's like this.
100%. So if we had to, because as I've mentioned, this podcast is focused to the retail trader, and we're giving information that they may not have access to. And I think, if I put my mind and kind of put that hat on, what question I'd like to ask is, the significance of a liquidity provider. We obviously know that it's very significant to the broker. What could go wrong with a liquidity provider that could trickle down all the way to the end trader and impact me? So if I'm a trader, right, and I've gone to ABC Broker has got a certain bridge. Let's ignore what bridge technology that is, and that bridge is connecting to Broctagon. What risk is there? What happens to Broctagon? How is Broctagon safeguarding itself? Every company has its risks, its vulnerabilities, and you cover your risks and your responsibility in your vulnerabilities with you mitigate them as much as possible. Based on that, what could go wrong with a broker? What can we give the retail trader here to
understand? Okay, so issues, technical issues first of all. You have on the fixed APIs that they're coming from the bridges. At any given time, because the responsibility is falling under the bridge providers themselves, they can go out, can get disconnected at any given time. So having a main source of liquidity, just one source of liquidity, that one specific bridge provider has any sort of problems, it can stop all the prices that they're streaming to the broker. That will eventually affect the clients. So retail brokers are not forced, I would say, but it's better off if they have several liquidity providers from their side to have a backup or a failover feed into them. So when one of those connections gets disconnected because everything goes through the internet, they have immediately another one that can support the prices without affecting the clients. Now, second thing, trades, they're going back and forth the whole time. So if the risk management here is doing the job very well, and the liquidity provider or Proctagon or any other liquidity provider is doing their job properly, then again, you don't have any risk, provided that the market is moving to normal conditions. Now, I'm gonna expand a little bit more on the Black Swan event that took place, because from our understanding, without even working in any of the companies that they were affected on the Black Swan event, it wasn't their fault altogether. So what was the Black Swan event altogether?
Well, I think there are many Black Swan events, right?
Yes.
So which one are you referring to specifically?
The one with the Swiss franc. Let's take the most common, or not the most common, the most...
The one that was the most impactful.
Yes.
That one
So
was...
you had clients. Clients were trading on the Swiss franc pairs. Brokers said that they were getting too much exposure on the Swiss franc, which was normal because the level of the Swiss franc was at the lowest at that time. So brokers wise, they thought about, okay, the best option for us is like we're taking a profit now and we hedge our risk to the liquidity provider. So let's look at it in numbers games. Okay, so you have clients, those clients that have deposited, let's say, 10 million with a broker A. The broker A transferred 5 million to the liquidity provider. That means those clients, they already lost the 5 million and the trades are still with the broker here. So the broker here already makes 5 million out of the losses of the clients. But then they decide, okay, the lowest levels ever, I'm going to hedge all my risk to a liquidity provider. So they just send the money over here. So what happens? The Swiss franc decision comes out, the market dropped, but the 5 million is not enough to sustain the loss or the market movement. So liquidity provider comes and requests from the broker, you owe me an extra 5 million. Then the broker says, wait a minute, that's my profits, which I was booking. So I don't think that this is going to be fair to do that. So this is when we introduced the negative balance protection in Europe, that because the brokers, they ended up going after the retail clients and asking them, guys, okay, you know, with that position, you invested as an individual $1,000, but your account's equity is minus 10,000. So you still have to pay us an extra 9,000 out of that. And the retail client says, wait a minute, I just invest 1,000.
Yes.
Why you want more money? And then these guys that were trying to explain that to the clients, these guys were pushing the brokers, you have to pay me more. And that's when we came up with a negative balance protection in this market. So in general, or to sum it up, this whole event, it was like a drastic market change, wasn't expected. So in this situation, the regulators came and they say, okay, between professionals, which is a liquidity provider and a retail broker, you're both considered to be professionals, or you can even be considered eligible counterparties, there is no negative balance protection. But we have to protect the end user. The end user is the client. The client cannot take that loss out of this equation. This is what happened on the Black Swan. So brokers that they were actually following a more, I would say, correct risk management, correct, I don't think that is the right word here, more appropriate risk management approach, they ended up suffering the most during the Black Swan event. And whereas you had brokers that they were massive B-booking brokers, meaning B-book, you take the opposite position of the clients lost all their money, the broker made all that money out of this situation.
Yep. We actually spoke about the SNB, Swiss National Bank event is what we refer to. And when we talk about Black Swan, there are many Black Swan events.
Yes.
Events. The 2008 market crash. Mm-hmm. I don't know. We could consider that a Black Swan. Black Swan normally is something that happens spontaneously, like instant, like
no one is expecting it.
No one expects it, and then that shifts the market somehow. And I understand I kind of agree with that, right? If you're a broker, you've got retail traders, you're professionals, there's no negative balance protection between the institutions. But the retail trader, and I can understand all sides, right? Yeah. Imagine you're a retail trader, right?
Why you take the blame?
Yes. You don't understand how the industry works, whatever it is. And all you want to do, if you do correct personal risk management, right? Yes. Where it cannot be professional. Let's call it amateur risk management. And in a basic form is, my salary is $4,000 a month. I have so much savings, just basics, the basics. How much do I need to live? Whatever. I can afford to lose 1,000. For example, in a year, just an example, basic example, money management, not in like a detailed kind of professional way. And I took that 1,000 and I'm going to risk it. I want to try and make an investment here. And I gave that to the broker. And all of a sudden, some black swan event happens, and all of a sudden, I owe 10,000. That's scary, right?
Yes.
That's scary. And I agree that, there should be this negative balance protection. On the institutional side, though, there's also the other side of the coin. It's unfair there as well. But if you want to be in this industry,
you have to understand.
You have to understand this industry. And, generally speaking, the brokers and the liquidity providers and the professionals in the industry do understand it to an extent a lot better than what a retail trader does.
Yes, that's
to
correct.
a certain extent. I kind of agree with that. So that was insightful. And actually it was coincidental because just the previous podcast that I had with Elena, we spoke about the SNB event.
With Elena as well.
Yeah, we spoke about it. Okay. So, Bandeli, if you believe it or not, there's an hour already has gone past. We've been
Really?
speaking for 1 hour. I'm trying to think what kind of topic we can kind of squeeze in over here before we close off. Obviously, let's do some closing comments. Let people know where they can find you, even if it is the retail trader. At the
If
end
they
of the
want to
day.
speak, yes. My mobile number keeps on ringing. Even now that we were speaking, somebody was calling me. The truth is, and why Proctagon became successful was that we came in the market very late comparing to the rest of the liquidity providers, and we said, wait a minute, guys, what do we have different than our competitors? So when we started having an LP relationship with one single LP, or a prime of prime, that's how they call it, we saw what was missing from the market. And this is what we try to cover on our side. So what we do, we don't go to the brokers and we say, this is our offering. This is what you have to take. This is what you need.
Take it or leave it.
Yeah. It's not like that. It's like, you come in, let me know your business model. Let's work together and see how we can assist. That's how it has to be. And that's we notice that is making a big difference comparing to the rest of the liquidity providers these days.
Obviously, it seems to be working because you're generating the volumes. When did Broctagon Prime start? What year was that? I don't remember.
That's a very good question. I feel like I've been working there for 30 years. But the truth is, when was it? 2017. 2017, yeah.
So it is very late entry.
Yeah, very late entry. Comparing that, all the liquidity providers, they've been in the industry for a decade or even more, actually. And everyone knew, especially in Europe, they have standard names that you were setting up a brokerage, you have to go to a specific LP. These are the names that you have to choose from. And then you're a very newcomer in this stage. And then you start to compete with them, which we found it difficult. It was very difficult until you get yourself out there. But the hard work really pays off. That's
of course. That's that is what can give anyone a competitive advantage, is just to put more work in.
Yes, that is very correct. Yeah.
Bandel, it's a real pleasure to speak with you every time. I can say that you have helped me at least once or twice in this industry to understand how stuff works. In our journey together as associates, let's call it, where we've worked together, we have many common customers. I look forward to many more years. Thank you for your time here. LinkedIn. People find you on LinkedIn. I think we'll do some links. Also, I need to kind of better my thing. Again, I'll have to comment. Please like, subscribe, and share this channel. What do YouTubers do? I don't know. There's multiple platforms. I'll let the people who do it better, but they tell me I need to say something. So like, subscribe, and share. It helps the channel. Thank you. Good. Thank you, Panteliss.
Thank you, Dinamo. Thank you, man.
It's a wrap.